Today we're going to talk about how to start out small in commercial real estate. And I thought that this would be kind of an appropriate um, conversation to have today, mainly because the last week, I guess, I've had several conversations with would-be investors that are either looking to, work with me or just kind of invest on their own. And I kind of keep hearing the same common reasons for not starting. And that is, Shane, I don't have the money. I don't have the time. What if I don't have any experience? And so I thought, okay, well, let's maybe knock out the first one, which is I don't have the money. And what I'm going to do today is I'm going to go into basically how to start out in commercial real estate on a small scale. And I'm going to show you what that's going to look like over kind of a 10-year period. So before I get into that, though, I want to kind of frame today's conversation a little bit. And really, it came about last week when I was having a barbecue with my daughter. And well, not just my daughter, but basically my three kids, and then they had three friends over. And my middle girl Blake, she is allergic to gluten, and so she's not able to have nuts or bread or anything like that. And we were having a barbecue with hot dogs and hamburgers, and she came in crying, not to me because she knows that I'm not quite as sensitive and sympathetic, but she went to my wife, and she was really concerned, not so much about not being able to have a bun, but she felt like she was being left out and judged. And she actually, when I started to have a conversation with her, she said, "Dad, do you know what it's like to fall off your bike?" And I said, "Yeah, it hurts." And she said, "Yeah, well, that's how I feel right now. I feel hurt because I'm not able to have a bun, and all the other kids are going to laugh at me and make fun of me." And I said, "Well, I don't actually think that that's the case, Blake." And I said, "Let me do a little experiment with you." I said, "What is Sarah wearing right now?" And she was outside playing, and Blake and I were inside, and she's like, "Well, I don't know." And I said, "What about mom? What's mom wearing?" And she couldn't tell me. And I said, "You know what happens is people are more concerned about themselves than they are with worrying about what you're going to eat, Blake." And I said, "Why don't you act as if it's normal to not have a bun?" I said, "Mom and I are not going to have them. And so, if anything, what you can do is why don't you be a leader right now and be independent and confident?" And so she tested it. And what was interesting is a couple of the other kids actually watched what Blake was doing, and they stopped eating their buns too. And I thought that that was kind of an interesting segue into today's show, because investing in commercial real estate for someone new, it is uncomfortable, and there are some unknowns and fear. And but what happens is, at least in my experience, it's a skill that's worth learning and exploring. And if you can be the leader, what ends up happening is other people will follow you. And so if you're investing in your own deals initially, because I'm going to show you how to do that today without other people's money, once you develop that skill, you'll be able to help other people. And they're going to start to kind of come in and say, "I'd love to be able to work with you, Shane," or whoever it is that kind of has that skill to be able to really help someone grow their money in a safe, predictable way. So that's really what we're going to talk to. And I thought what I would do is kind of show you a roadmap, if you will, on how I would start out investing in commercial real estate on a very small scale. So I think it's important to kind of start out by saying, like, number one, is commercial real estate, so CRE is just commercial real estate, is it even right for you? Because I know that some people, it may not be. So that is kind of a question that you have to answer for yourself. And what I would say is, uh, in my job, I think, is to show you why I think commercial real estate could be for you, and why I think it's kind of the best vehicle to be investing in, provided you have the right kind of knowledge and understanding on how to do it properly. So that's kind of number one. Number two is, or question number two is it possible for you to reach your goals? And so that kind of presupposes that you know what your goals are. And one of the biggest things that I help my clients initially is to understand and get clarity on where they're at. So we'll talk a little bit about that, but I don't want to get too deep into kind of that question today. And then number three is, who should you be listening to? And Obviously, I'm biased because I wouldn't be putting this content out if I didn't think that I was a credible person to kind of explain this. But you do certainly want to make sure that you're listening to the right people, because I can tell you that if you follow the wrong advice, you can end up going in the wrong direction. Um, and because this is such a big investment, going in the wrong direction for too long, it can be very costly. So, with that said, let's get into um, how to start investing in commercial real estate. And so, really, what I start with is the question of like, what is the game? And so, I've talked about this in the past, but just think of the game as like you've got properties, you've got the people that are involved. Oh, that's kind of out of focus there a little bit. You got people, you've got money, which is kind of the debt market, if you will, and then you've got external events, which is kind of like the government. Um, that is all going to impact commercial real estate. So this is kind of the game board, if you will. And then it's like, how do you get into the game and start playing? And then the third part is like, where are you starting from? So I know that it's probably kind of hard to see right there, so I'll just lift it up. But essentially, I've got three different buckets here. And the first bucket is like you're looking to make money, right? If you've got anywhere from kind of 50 to 500,000, most of the people are going to be focused on making money. And what that means is you're going to be adding more value to a property. You're going to be a lot more involved in the deal. Bucket number two is how do you grow your money, which is you're kind of in that 500,000 to 5 million, and you're looking to, you don't have enough right now to retire, if you will, but you're not, you can be a little more patient. Okay, that's maybe the best way to put it. And then the last one is legacy, which is basically you've got $5 million plus in net worth. And at that point, you're able to say, you know what, even if I just got a safe and secure 6% return, you know, at $5 million, fully invested without any leverage, you'd be getting 300,000 a year. So these numbers are somewhat arbitrary, although with my clients, I find that those are kind of the buckets they fit in. So that is kind of the map, if you will, right? And what I want to talk about now is how to start, right? Where would I start? Knowing what I know and without any of the resources that I have available to me. Because obviously it's much easier for me because I've got, 10 plus years of experience and I've got lots of investors now. But I know that if you're just starting and you're saying, well, I don't have $1 million to invest, Shane, like it doesn't even seem like commercial real estate is a viable option for me. Well, if you, um, let's say you're just investing in residential real estate. I mean, in most cases, if you're putting 20 to 25% down, at least here in Calgary, you've got to come up with, call it $200,000. So I just use that as kind of a benchmark. And so you can see at the bottom here, I know it's kind of hard, but if you're starting out with, let's say, just $180,000, in most cases with 30% down, you'll be able to buy, call it a $600,000 property. And so on the, I always get them confused, but I think this is the x-axis. You've got basically, this is the equity that you're going to grow over time. And then on the y-axis is time and how long things are going to take. So first, let's talk about the assumptions, because I think that that's critical. If I didn't tell you what my assumptions were and I just showed you these numbers, they may be too unrealistic or too unreasonable. So what I thought I would do is kind of give you what I believe are reasonable assumptions. Now, there's so many things that we could put into a model, but I thought there's no point in in making 200 assumptions because then we would spend all day. But what I wanted to do is kind of give you some high level. So let's say you're starting out with $200,000 or less. We're basically going to find properties that have vacancy or under market rents, right? We're going to find properties that have something wrong with them. We're going to find properties that have a 6% cap, which essentially means if you bought the property all cash, you would get a 6% return on your money, right? $1 million property, you get 60,000 a year. So just keep that in mind. Interest rate, we're assuming 4% interest rate. So there's a delta, right? There's a gap between your cap rate and your interest rate. We're going to assume in year one that we increase the net operating income. We're basically going to push the rents in some capacity up by 25%. And just so you know, I mean, I've got my spreadsheet over here. But really what that means is, so in year one on a $600,000 property, that would, the NOI on that net operating income would be $36,000. All we're going to do is raise it from $36,000 in year one into in year two, $45,000. Now, how we do that, I've done entire videos on how to increase the rents, if you will. So I don't want to get into that right now, but just understand that if you've got a little bit of vacancy, that number is very achievable. Or if you've got tenants that are paying under market rents, once again, very easy to achieve. So I say very easy. This is not an unreasonable expectation or assumption. Okay. I'm also assuming no partners. I'm assuming when you sell these properties, you're not paying taxes. In the US, you're going to have a 1031 most likely. In Canada, I understand that you're going to pay taxes, but the truth is, you could probably do a refi, pull out most of your equity, go into the next deal. So there's a lot of different ways you can do that, but let's just keep the model simple. We're going to assume a 3% selling commission, because if you do sell, you will be paying a fee more than likely. I mean, you might be able to sell without a broker, but let's just kind of make that assumption. And each property you're going to hold for 3 years, right? So all I'm doing is increasing the NOI at 25% each time we buy a property, right? So this is basically property 1 here, property 2 here, and property 3 here. Okay, so in 9 years, you're going to buy 3 properties, and you're going to sell each property after 3 years. So let's just look at what that looks like for property number 1. You bought it for $600,000. You put $180,000 equity into the deal. At the end of year 3, you're going to basically have generated. I didn't have enough room to put all this on there, so just bear with me. Because you've increased the NOI from $36,000 to $45,000, we're going to use the same cap rate, which is 6%. So the value has gone from $600,000 to $750,000, which, if you were to look at your return on investment, because you're getting cash flow all throughout this, you're going to have about a 37.8% annualized return on your money. So that's number 1. And if you were to spread out what you earned over the 3 years, it would equal $5,874. So each month. Now, that may not sound like a lot of money, but when you think you're starting out with $180,000, at the end of that period, you're going to have net proceeds of $338,000, right? So you started with 180, you're going to have 338 to go into your next deal. If you were to look at the delta between the two, like how much money did you actually collect over that 3 years? It would be $205,000. So you've more than doubled your money, right? Yeah, you put in 180, you're getting 204. You're going to have more than doubled your money in 3 years. Now all I'm saying is you roll that money into the next deal, right? So now you've got 338 as your capital, your seed equity, which means you're going to be able to purchase. I just want to get the right number for you. The number is going to be, I believe it is, yeah, you're going to be able to buy a $1,130,000 property. Okay, so here now you're at $1,113,000. When you increase the rents by 25%, the value goes to $1.42 million. Once again, you're getting 37.8% on your money, because all the same assumptions are true, and your monthly revenue now will be $10,689. So that's just after 6 years and 2 properties. And all you've done in the first property is add 25% to the top line, if you will. And you've done the same thing one time. So you're not adding 25% each year. You're basically going in, you're fixing a problem, you hold it for 3 years, you sell it, then you buy the second property, you fix it, and then you hold it for 3 years, and then you sell it. And then basically at the end, the third time you do this, which is going to be at the end of year 9, you will have created 1.12 million of which would be money in your pocket if you were to just basically take that money. Now, what I would suggest is you would go into the next deal, but on a monthly basis, that's over $20,000 a month. And that is starting, like I said, with $200,000 of seed money. Now, you can see that you're going to have to do some work, right? You're going to have to work in year 1, year 4, and year 7. But all this is very doable. And the reason I wanted to kind of illustrate this is I think that when new investors come into commercial real estate, they feel that it's too daunting a task to get into $1 million properties. But you can see here, once you've got 1.12 million, I believe is what the, let me just tell you exactly what your net proceeds are. Yeah, 1.2 million, sorry. 1.2 million. That's going to let you get into, if you were to do the deal all on your own, a $4 million property. But this hasn't factored in that you're going to have any additional savings, right? Let's say each year you're putting away $50,000 to $100,000. All of a sudden, you might be able to do, a couple of these deals or one deal every year. And if you were to start stacking a deal like this and layering it in over 10 years, you can see what happens. I mean, it's just that's in my mind the real benefit and beauty about commercial real estate is because of this leverage opportunity. So that is really kind of the big picture. I know that I walked through this kind of quickly. I've done another video like this where I think it was almost 45 minutes and I talked about, using different numbers, bigger numbers. So I thought I would start off using smaller numbers. So I think what I want to kind of finish off today, let me just see here. There's a couple of things I did want to talk about. And maybe I'll get into that and it'll be a little bit off script. But so the progression of commercial real estate investing, what I think is important is that when you're starting out and you've got kind of a low net worth, it's more likely that like these two kind of work in tandem. You've got two graphs, if you will. One where net worth is on the, because I've got a cold, I don't know if you can tell, but my mind is just thinking at like 75%. So just kind of bear with me here. So you've got net worth on the x-axis, you've got time on the y-axis, and then you overlay risk, and then you've got time. And what happens is as time progresses, your net worth should increase over time. But what also happens is as your net worth increases, generally what happens is, at least with really kind of sophisticated investors, is they take less risk, A, because they have more experience, so they know what they're doing, and B, they just start to move into different, like what I put in here, right? I've got properties. So if you think about risk, kind of your highest risk is going to be development properties, right? You're going to be, when you're developing, the returns are going to be much higher, but the risk is obviously greater. Then you've got value add properties, and then you've got kind of your core plus properties, which are in like major markets. If you are in, let's say, a small city, like I'm working with a gentleman right now who's in quite a small town, the truth is, I mean, the returns he's going to get are unbelievable. I mean, I think that he'll double his money probably in 2 to 3 years if he does things properly. But he's in a small location, so he's got less buyers for his property. Although he's in that location, he's going to be able to really capitalize on it because he understands who the players are. But, as time progresses, he's more than likely going to move his money from small to major markets because now all of a sudden his risk goes down. Sure, his returns will go down, but because his net worth is increased, he's able to offset that. So that's kind of like a big picture, if you will, of like the progression of commercial real estate investors. And I thought that I should probably just kind of mention that. Now, the last part that I don't know if I've got enough time, but I'll kind of touch on it here because I think it's important. And that is, think of like 3 circles like this. And you've got, this is how, when I work with clients, I mean, you could even overlay a triangle, but that kind of looks a little messy. But you've got these 3 circles. And in circle number 1, really, the key is being able to find the right deals. In this circle, you've got financing. And then this one, you've got fixing, okay? And in each, so this is like the 3-part framework that I help my clients with, because in each one, you've got 3 different sections, okay? And all I'm trying to do is give you the big picture right now. So you've got finding properties, financing properties, and fixing the properties. Inside finding properties, you're going to have the location is critical. And inside location, there's a bunch of different factors, right? and then you've got timing, right? And then you've got property, and then you've got property, sorry, right? The actual property itself. So all three of these factors flow into finding, and each one of timing, for example, and then the types of properties, value add, development, they all have their own kind of separate framework. But what I'm trying to do is give you like the big picture, if you will, of commercial real estate investing, how I see it, right? Now, when it comes to financing, geez, camera keeps on going out of whack here. You've got debt, which is critical. I just did an interview with Chris Heron on debt, and so there'll be a link hopefully to that. On financing, you're going to have equity, right? This can be your own equity or it can be partners' equity, right? One of the big things I do is I syndicate my deals so I can do bigger deals. But if you're starting out and you want to do that, like I said, just a small deal on your own, that's fine. The progression would be to move, and as you get experience, then you can start to, if you like, invite other investors into your deals and get into bigger deals. And then that really leads into structure. So how do you structure your deals? As it relates to fixing your properties, these two here, I believe a person financing and financing and finding properties, I believe you need to be very skilled in this. With respect to fixing, I view this more as like an asset manager where you oversee other people. And so on this, I really look at, you need the right team. This is going to be, you got to have your operations set up, and then you've got to get your leasing squared away, right? And so this is like, now, like I said, in each one of these, there's like a framework on how to do each one. And what I basically do in my in these videos, if you will, is I go into each one of those very detailed, and then obviously with my clients, I break it down and we go into kind of each framework step by step. But I thought that today I'll give you the big picture, how you can start. Does this make sense for you? Yes, no. Obviously, if it's no, then you probably turned this off a long time ago. But if it's a possibility, then what I would say is go get my book at clubsyndication.com. It's free right now anyways. And obviously the free version is just the PDF. If you want a physical version, I just charge shipping and handling. So I cover my costs. But yeah, you can get the PDF. You just put your name and email and you can get the free book. And I also have in there kind of a bigger breakdown of my framework. And I think that you're going to get a lot of value out of it. So that's all I wanted to share on today's show. I hope you enjoyed it. If you did and you've got some value out of this and you'd like to leave either comments if you're watching this live or on Facebook, or if you want to go to my podcast and leave a 5-star review and what was kind of the biggest lesson or takeaway from today, then I'd really appreciate that. So that's all I've got. Hope you enjoyed it, and we'll see you next week. Bye for now.